Portfolio builder, thanks to government antitrust probes, Google and Amazon have sold off considerably, and now the option premium is too hard to turn down. So we are issuing the trade alert to buy 100 shares of Google and 100 shares of Amazon. And the potential profit, if we are able to achieve this sort of profit week over week for 52 weeks, is around a 28 to 33% annualized return. Now, this is only possible with this huge amount of defense to the downside while volatility is high. And I do expect volatility to remain very high due to the US-China trade war probably escalating before it is resolved. So this has a lot of downside protection, and we can actually generate a larger profit if there's a sharp enough decline in the underlying asset, because we're taking half of the profit of our covered call and buying a further out put option. So step one, buy 100 shares of GOOG, G-O-O-G, not the one with the L. This is the Class C shares. Sell to open the June 14th, 1032.50 call option. You'll get a different credit than me. It doesn't matter. We're placing this trade where Wall Street is placing their trade. Then we're going to buy to open the June 21st 1005 put option for approximately an 860 debit. Again, the prices fluctuate, but whenever you enter the trade, it will be the same potential profit ratios and protection ratios that are looking at the key levels based on the strike and the expiration date. So the potential profit on the Google trade is around $500 a contract if we lose everything on the put option. So that means if the market goes higher, we generate $500 a contract. However, if the market does travel down slightly or a lot, the potential profit can change. So I'll cover this in more detail in the evening update. I want to get this out. Step two, buy 100 shares of Amazon, sell to open the June 14, 1720 call option for a $36 credit. Then buy to open the June 21st, 1655 put option for a $12 approximate debit. And so this has a potential profit of around $1,000 and has a slightly higher potential return. Here's a chart of Google. You can see it's sold off pretty rapidly over the last month. Here is how to place these trades. Here's the sell to open. June 14, 2019, 1032.50 call option for a credit of around 1960. What's important is the strike and the type of trade and the expiration. The exact credit you get will be fair relative to the price of Google when you get into the trade. Of course, you've got to have the put option protection in times like this. So we can potentially sell this put option next Thursday for a profit. And that is to buy to open the June 21st, 2019 1005 put option for a debit of 860. If we do look at the option data, we can see Wall Street has a pretty big order at the 406. And I ended up moving this to the 1032.50. So ignore that arrow on the 1035. But we're protected to right around where Wall Street has a big order to purchase the 1030 strike Google shares. Now on Amazon, very similar setup. Sell to open the June 14, 2019, 1720 call option for a credit of $36 times 100. Then we're going to reinvest part of that potential profit, about half. In both of these trades, we're taking half of the profit of the credit, assuming the market goes higher, and we're putting it into a put option. And that protects us below our strike price where we've written our covered call option. So we can see Wall Street has its biggest orders at 1030, or rather 1730 and 1720. And so we have plenty of protection to that area with our covered call. And then on top of that, we're going to have that further out of the money put option. So that is a wrap for the Whale Club. Next Thursday, we will sell the long put option, which could potentially be for a profit if the Google or Amazon has traveled lower. And we're going to roll over our covered call. And we're going to repeat this as long as Google and Amazon are selling at a relative discount. and the option premium is relatively expensive for the call option speculators. So again, in the evening update, I'll go over the math on all this in detail, how it works. But in general, just know that if the market goes higher, Google and Amazon go higher, we're going to make right around this guaranteed profit per contract. If the market goes sideways or down, we can also profit, and that will be a fluctuation relative to how much our put option goes up and if we are trading in the range that our covered call protects us. So again, I want to get this out, and I will cover it in much greater detail in the evening update. So thanks again.